Okay, good afternoon, everybody. Today is January 12th. This is your weekly take on the market. It is 1 o'clock Pacific time. The bell literally just rang. Um, I'll be your host. My name is Scott St. Clair. I am the manager of the Premium Product Group here at Investors Business Daily. Please take a moment to read the disclaimer. I'm not licensed. I can't make buy, sell, hold, allocation decisions or recommendations. Nobody at IBD is licensed that I'm aware of. This is for educational purposes and informational purposes only. Okay, market thoughts. We'll talk a little bit about the market. I'd like to focus more on the stocks, and then we'll try to get into the industry groups a little bit, and then of course the quote of the week. So I hope this isn't too blurry. I found this on the internet, on Twitter, I believe, and I apologize. I've had this screenshot for a while, and and um I dump a bunch of stuff into PowerPoints. Oh, I think that's interesting. That's interesting, and it fills up. And I don't believe I've ever shared this, but since it's the start of the new year, I think this is a good thing to see. It's the compounded annual return of some of the greatest known investors of all time. Um, some of these guys are, it's probably an estimate, like Michael Marcus. I don't think it's an audited return. Uh, Running, in-house money. Even William O'Neill, it's an in-house return. So it's probably a rough estimate, give or take a few percentage points, but uh, you get the idea. And what I like about this is that you've got a big difference, like Richard Dennis, incredible, 120% for 19 years. Michael Marcus, 120% for 10 years. Jaffrey Woodruff, he was in hedge fund market wizards, 118%. Bruce Kovner. So you've got some incredible guys, and then you've got some stalwarts that did it incredible for a long time, like Greenblatt, 45% for 19 years. O'Neill, uh, Rogers, Druckenmiller, who did it on big money. Robert Wilson, 34% in 20 years. He was most famous as a short seller, but I read his book. He actually has a book. I think it's very readable, kind of an underrated book. But he actually made most of his money being long. He would use his shorts that would allow him to be aggressively long. And I think he estimated that he didn't really make any money on the short side over his lifetime, even though he had a couple of incredible calls. And then he has a very famous short squeeze story, which is a really good read. So if you've never heard of Robert Wilson, I'd do a Google search on him, read some of his stuff. But then you've got like the Templetons, the John Neffs, the Klarmans, Daniel Loeb, Jack Dreyfus. These guys all did, teenager did returns for many years. And I think the main point is we all want to double our money every year, over and over and over. It's just not possible. I think Michael Marcus like burned out, trading as actively and aggressively as he was. That's why he only has a 10-year track record. So, if you do the rule of 72, if you make 25% a year, you double your money in less than just under 3 years, I think is the number that if I did that right. And so, you double your account, and then you double it again, then you double it again. And especially in tax deferred accounts, that in taxable accounts, it doesn't quite go the way you'd like, of course, because you got to take out money and pay your partner, Uncle Sam. But in tax deferred or non-taxable accounts like a Roth, you get a double, and then a double, and a double again over 20-25 year time period, and you're basically you're in good shape. You could be done. Of course, we all want to do it again, and that's the goal. That's the market for you. That's what keeps you in the game. But so uh, you know, be kind to yourself. You don't have to make 50, 100%. I see on Twitter all these people that, post their screen accounts, their screenshots of their personal accounts. And I'm just going to take it for face value that it's real, that's true, that they made 117% or whatever. You don't know how on the starting point on how much money. as the money gets larger, not only is it harder to move around, but psychologically it's a little bit different because you don't want to go backwards. When I opened my first account for 3,500, I didn't think about it at the time, but there was very little risk. And the risk was I blow that account up, and and I start over again one more year later. But as you get older and the money gets larger, you get into a little bit of protection mode. And even Bill was that way with the money as he got older. Uh, a lot of the in-house rules. Well, I wasn't there when they were really aggressive, but my understanding, from the people I heard, like Justin, et cetera, the stories is, a lot of those in-house rules were different. They were more structured for protecting preservation of capital. So, um, all right. So let's get into the markets. Pull up the indexes, and it is what it is. I mean, I just don't see anything wrong with this chart. It looks fine. It rips up, consolidates, rips up. A little bit more of a consolidation. A little bit scarier, which is actually nice. Does a little good job of shaking you out. Up 5 days in a row, and I think you just at this point you're just in bull mode. For someone like me, I like the ballast, the balancing of having a short sale idea or two, um, a la Robert Wilson, and it just allows me to be more aggressive on the long side, like that, and I just don't feel the ebbs and flows as great. So if I'm getting hurt on the shorts, hopefully my longs are doing really well, and vice versa. And in a perfect world, you're long Tesla and short, Ford Motor. That's what we all dream of doing. It's not that easy, of course, but that's the idea. So I want to be long the leaders and short the laggards. And usually it's, like for me, it's probably 80-20. I'm probably like 80% long, 20% short type thing. I just think that's more than enough uh, in this environment. And most people, honestly, I doubt Bill O'Neill would be short anything here. I just don't think he'd think that it'd be worth the effort. So, and sometimes I wonder myself. So there's that. So I think the market's fine. Take it day by day until it does something out of the ordinary negatively. I'm just going to give the market the benefit of the doubt. The S&P looks very similar. It's fine. The fall through day is there, I believe. So that's day 1, day 2, day 3, day 4. And, and a lot of us probably thought, oh, is this one going to work? And you hem and haw. And this is why, if you're in cash, you buy something on the fall today. You always buy something. That way you get some feedback from the market. If you bought NVIDIA there, you bought CrowdStrike there, you bought ServiceNow there, you bought Microsoft there, it just went up day after day after day. And gradually, as long as you're not pigheaded about it, the market will pull you in more and more. You'll add to that one, you'll buy something else. And if it goes bad, you have a very small loss. As far as like world markets, I think China is really, really bad. I don't know why. It's just kind of off my radar. Um, maybe it can do something, but as of now, I just don't see any reason to be involved there. It's not my style to try to pick that bottom. And there's one good Chinese stock, PDD, but all the others look terrible. So if you avoided that market, it's been the right strategy so far. I really like the Japanese market, EWJ, breaking out of the space, and it's been a long time since it's been this high. So I do have a position in this one, and we'll see. So far, so good. And there's others that are doing pretty well, but the U.S. market is the straw that stirs the drink. It's been so good forever. All right, the industry groups. And I was a little surprised to see coal is still number one, but the stocks look great. AMR, METC, they're not buyable, I don't think. Well, I really don't think. but they're holding up. So if you happen to own any of these, AMR is the leader. And a couple of you emailed me about AMR, like, why, how would that be on your radar, Scott? Look at the earnings and sales across the bottom are pedestrian at best, terrible at worst. And it's just watching the industry groups. And I know a little bit about this story on AMR. Monish Pabrai, who runs a value fund, he has some really good YouTube videos on his style. I like listening to him, and I don't invest his way, but that doesn't mean I'm not open to listening to the way he does it, because he's been very successful doing it his way. And I just like the way they think. I just like the way great investors think. They think about risk, they think about reward, they think about position sizing, and so I like to listen to all of those guys. But he had a position in this, so that kind of put it on my radar. I saw a value guy with a position in coal stock. I think it was him who said you can't you can't have steel without metallurgical coal, so the world wouldn't exist without it. And as much as the ESG movement, we want to get rid of coal. I don't know. It just doesn't look like it's going to happen in my lifetime, anyways. And the stock would have shown up on your radar with just a simple relative strength slash industry group strength screen, and then it becomes down to open-mindedness, imagination. Probably I probably couldn't imagine that coal stock could double or triple or outperform Nvidia last year or something like that. So you have to kind of have the imagination. You put your chips down, you start with a small position, and maybe you build it into a larger one. And if it's going your way, and if it doesn't, you just stop yourself out. So coal is still number one. Food, dairy products, too small group. Computer software security, very good group. So you could be loaded up there. Zscaler, Palo Alto, CrowdStrike, if you prefer the technology type stocks. Computer software, financial, that's like Intuit. Medical, biotech. I don't think Lilly or NVO fall in those categories, but Vertex has really been showing short-term strength. That's in that group. I'll pull that up. I do own Vertex, and it's got a huge number of stocks. Obviously, it's the largest group by a country mile, and number 5. So even with it's probably got a lot of laggards in there, it probably also has a bunch of small stocks that have quadrupled and stuff. But our groups are weighted to the larger price stocks to try to filter out that noise on the smaller end. Long-term care, household furnitures, a lot of banks, not a whole lot here. Doesn't look like a massive new bull market type industry group, but I like the diversity of it. If you owned AMR, if you own Vertex, you own Nvidia, you own Meta, you own Microsoft, you own Uber, you could maybe own Tidewater, you own a uranium stock. I mean, gosh, you could call Jim Cramer and even he'd think you're diversified. Does he still do that segment? Am I diversified? I can't remember the last time I watched CNBC. So, but I know he had like a segment where he would do that. All right, so let's jump into the leaders. There's so much quality. So the narrowness of this market is not as narrow as a lot of us, and I'm probably as guilty as the next guy or girl about that kind of that narrow-mindedness that the market's so narrow, there's nothing to buy, and you have to kind of get out of that mindset. The indexes did really well because of the Nvidias and the Metas and the Microsofts of the world, but ServiceNow is probably in there. AMD, PDD, Palo Alto, Lululemon, Deckers, A&F, Abercrombie, CCJ, Zscaler, AMR, Melly. These are all stocks. I just was trying to make a list of what I thought were the leaders and maybe the second tier leaders. And I just kept writing down tickers. This is incredible. So like Microsoft, very good coming out of this base on base. It's big, it's liquid. It's not going to set the world on fire probably. But I could have said that 100 points ago about Microsoft. Meta, oh, I keep messing that up. Sorry. Meta. Wow. And again, I need to develop some patience. I actually bought Meta on this day. I felt like it was a good shakeout on the earnings, and it closed in the upper range. And, I sold it 2 or 3 days later. It's the story of my life, unfortunately, sometimes. It was a great buy. uh, Maybe I'm trying to get better at it. Like uranium, for example, today is my instinct is sell, just sell. It's up so much. Take it. And I just like did very little. I tried to slow down and just take a little bit off. Don't sell at all. So Meta is acting great. Nvidia broke out. Hopefully, I would guess a lot of you have that acting really, really good. Nothing absolutely wrong with that one. I did mention Vertex. So it's a little bit in this really big day, kind of a weird base. You have this really big day, and then it holds that, and it's just kind of stair stepping higher. It's probably one you need to be patient with if you own it, but they're in the gene editing area, the CRISPR area. They've got potential for, my understanding is an opioid replacement that doesn't have the same addictive structure as the opioids have and created all these problems. And if that's the case, this stock could go a long way. But you gotta kind of understand how it trades. Kind of trades 2 steps forward, 1 3/4 steps back. But what I like about it right now is it's very early in the move, so it could do back, it could go back to what it's been doing. But look back on the daily. When's the last time it was up that much in a single day? 13%. That's unusual strength. And then now it's just kind of stair stepping higher. So I do have a position in that one. So let me move down this list. CrowdStrike, which I have moved on from, unfortunately. But I love the relative strength. So when the market was selling off, let me backtrack a little bit. So the market was selling off right in here. I did it. What day is that? That is January 4th. And the 4th was a Thursday. So on Friday, the market tried to bottom and it got a little bit not all that great. Like it looked like it tried to go up and then couldn't. I actually thought the market was going to continue to go lower. I really did. But I ran a relative strength within 5% of new high screens. And the number one stock that showed to me that kind of stood out like a sore thumb was CrowdStrike. So I bought it that day right there. And but this is just hard for me. I just love to ring the cash register. It's my weakness as a trader, and so I've moved on from it at this point. But relative strength new high, relative strength within 5% of new high. These are great screens. It's really difficult for a leading stock to not show up on one of those screens around the way. They should be your go-to screens. And what it also does is it kind of gets you in the mindset of like, this is really good. This is fun to me. I want the market to pull back because then I can see what doesn't want to go down. If it just kind of powers up and up and up like it has been, like this market, like this period right here, I underperform the market. I'm always going to say always, but I tend to underperform the market because, I'll buy and then I'll feed some out, and then I'm underinvested as the market keeps going. But in a market like this, where I can see what's acting relative strength, especially something like this. This is like a really like a perfect type of market because you get some shakeouts. It goes up, it goes sideways a little bit for a number of days to weeks. This really allows you to see what doesn't want to go down. So I'm hoping that the market can do some of that. It doesn't even have to go down, just a little bit of sideways. So RS line new high. So Crowd, Uber. Look at that, another shakeout. Great shakeout by Uber. It looks a little, short-termish, like it. You see, you've got this kind of. It looks like it's running into resistance a little bit up there, but acting fine. I don't know. I don't know. The only one I've met that I own that I mentioned, or I own Nvidia and Vertex of the ones I've mentioned. ServiceNow, another great example. Salesforce CRM. And these are big and liquid, and you can sleep at night with these names, and they're just great names. You know, second tier, and it's just me trying to is nothing. There's no system to what's first tier, what's second tier. I'm just kind of making it up as I go along, honestly. But like AMD, I would consider like second tier. Nothing wrong with being second tier. It's like second tier of the greatest stocks in the market right now. Lilly looks great, just a little slower if you own that one. Same kind of thing with NVO. Um, Netflix is holding up really well. Pulte Homes, and I'm gonna go a little fast just because I have so many names here. Toll Brothers. You know, look at all these stocks that have just held up really well. PDD. I dropped the ball on that one, and it saved me on the Babas and the JDs of the world, but it hurt me here. I just kind of created a kind of a mindset that no Chinese stocks. Palo Alto, right up there with CrowdStrike. Zscaler, Lululemon, which this is a Lululemon shirt. I wear their stuff all the time. How come I don't own the stock? Another Deckers. I don't own any of that stuff, but ANF and on and on and on. So there's just look at this. There's just really good merchandise out there. And so it's very easy to have a 10, 12, 20 position portfolio. Uh, Last but not least, the uranium stocks. These are very extended. Can they go higher? For sure. Anything can happen. It sounds like kind of what the people that I were following on the uranium trade it's coming to fruition. There's just no supply of the physical stuff. And if you run a reactor, there's no price you won't pay to keep that reactor going. So if you have to pay $100 a pound, or $200 a pound, or $400 a pound, I think it's just over 100 as we sit here. The physical, you're just going to pay it. And Kazatomprom, because I can't say it, but so Kazatomprom, probably the biggest in the world. I wonder if they're bigger than CCJ. They might be. They just can't supply what they've promised. So what do? They might have to go to the physical market and just buy it. They can't take it out of the ground, and that really moved, the miners, CCJ, UEC, and the little speculative position I own, and then of course the ETF, and it's just like, look at how great this setup is. Now, I know it's uranium, and some of you might say not interested. No problem. But from a technical standpoint, price action wise, you got this breakout, then it builds another base, and it just sits there and just gets so tight, just like doing nothing there. It's like just like so quiet right in there, and then you get a big up day, and then and then it just blasts off. Now, I don't know. As we sit here now, obviously very extended, but maybe it's the start of another lag. And the last time, uranium can leg higher, not too much, but this was a nice leg, and this was a really good burst that I was involved in. Didn't last very long, but 3 weeks is more than enough. So that's that. If some of you are asking, and there's another ETF, URA and YURNM versus URA. URA does not own any of the actual physical uranium. It's miners, whereas URNM I think has a 15%. It's not as much as I'd like, and there is a physical which I own. It's SRUUF. I can buy it at Fidelity, but I can't buy it at TD Ameritrade. I guess you can buy it at Schwab, and I've owned it for a while, and it's done amazingly. So there's been a way to participate in something like that. So it just kind of goes to show you the diversity of the market. On the downside, the stuff that looks tired and or losing leadership, Tesla for sure. I am short it. Look at the number of days down, 2, 4, 6, 8, 9 of 10 or something like that. And the relative strength's really falling off. Coin. So the first day of the year, which was here, I think, January 2, it actually was like 185 in the pre-market. And by the time it opened, it was 165 or something like that. It was very, very volatile. Maybe, this isn't exactly the nicest pullback to the 50 days. That to me looks like it's lost leadership. MSTR definitely lost leadership. It's the whole Bitcoin thing for whatever that's worth. And then, you've got the Affirms, which actually, I don't like the Affirm business. I think it's a accident waiting to happen, the business they're in. But I'm not short it and just watch from afar at this point because the stock is acting really well. And Carvana is another one of these stocks losing leadership. So these were some of the leaders late last year: Coin, Affirm, Carvana, etc. Okay, so let's go to the quote of the week. Come on, talk to me here. Let's go. Quote of the week. Peter Cunhill. The book is "There's Always Something to Do." The ultimate skill in this business is knowing when to make a judgment call to let profits run. I really like that quote. It's absolutely so true. I've lived it my whole trading life. It's very hard to know which ones to sell and which ones to keep. It was a common question we get over and over and over at workshops, et cetera. Well, how do you know which ones to take profits at 20%, which ones to keep and let them run? And I just don't think there's any perfect way to do it. There are some things that could help, like, Bill does have his, 3 weeks up 20% rule. Um, the quality of the company, the earnings, the sales, how well you know the business, the size of the company. As strange as it sounds, I think the larger the company is, the more you probably want to keep it. So something like Nvidia, Microsoft, Meta, Apple, the winners just keep on winning. The Coins, the Affirms, the Carvanas of the world. I think if you're buying those and trading them, no problem. Just I would probably put those in the pile of 20-25% profit takers. So that's kind of how I think about it. But even that's not perfect. You're gonna make mistakes in that regard. So um, it's tough. This is the ultimate skill. I agree with it wholeheartedly. If you know you can get even moderately good at knowing which ones to sell, and this is when you have profits. When you have losses, it should be pretty simple. Cut them. But when you have profits, which ones to keep, which ones to cut, and maybe it's a little bit of both. Um, there was a book the guy called it "Taking a Bite of the Apple." So don't eat the whole apple; you just take a bite of it. So if you have 1,000 shares of Nvidia, maybe you sell 100 here, you sell 100 there, you sell 100 here, you sell 100 there, and then it's frustrating. Of course, you got 600 shares up 100 points, and you think, well, I should have 1,000 shares up 100 points. Well, that's easy to say. If it turns down and the game is over, you might have some really good sells on the way up with a couple of hundred shares, and it'll help reduce the volatility. Um, Being able to stay in the positions is important too. So, okay, Marcus Smith at investors.com, 800-424-9033. Have a great long weekend. That's right. It's a long weekend. The markets are closed Monday. We will see you next week. Bye-bye.